Hello friends, to this special session on dividends. Now a lot of people have some good concepts, some bad concepts around dividend, and they feel that if you are investing and if you are getting dividends, that is the holy grail of investing. So let's try to dissect this topic and try to understand where the dividend is very, very important, where it is not so important, and how to think about this entire process. So let's dive in. This is going to be super interesting session. All the things about dividend will be cracked in this particular session. So let's jump in. Alright, so first let's understand the concepts. Why dividend and the understanding around the dividend is important. First, it is very important to understand the capital allocation of the company. Where company is putting money, that will decide the fate and the investing returns of any investor. That is where it is very, very important to understand how is the capital allocation. It also gives about the idea in terms of what is the business model of a company, because it's not like dividend is good for each and every company or bad for each and every company. Suppose there is a business model where a company doesn't require capital to grow. They might be giving out everything as a dividend. So that's perfectly fine scenario. But imagine there is a business where they don't need to give back the money. They can actually reinvest the money into their business at a higher ROCE. It's very bad to give dividends. So those kind of idea around business model will get into this particular session, and we'll understand the concept, whether the company is into steady state, whether it is a medium growth company, or it is something which is heavily reinvesting for the future growth. In which scenario dividend is very important, where it is not useful, and where they should avoid giving dividend. Third is it will also help you as a shareholder to take better decision, because when you understand the game, what management is doing around all these decisions around dividend, you will be better able to take that call that whether yes, you need to invest in this company, or you can avoid and not invest in that company. And fourth, it also helps in valuation at times. A lot of people just do price to earnings multiple, price to book value, DCF and all that. But if you are able to gauge dividend, and if it is a really steady state company, you can also get valuation of a company through dividend yield, and some of these steady state companies can give you an idea of what is the kind of fair value they are going through. So that is where this entire session, what we are going to do, like next 15 minutes, is going to be super important if you want to understand everything about dividend investing. So let's first understand the capital allocation part. So when a company is getting money as a profit and then as a cash flow, how can a company distribute that money? There are only 5 ways in which company can give back or distribute the capital. The first way is to invest in existing business. That is where they can put money back to the business and use it for future growth. Sometimes they can also acquire other businesses. They can acquire other company and they can use that as an inorganic way of growing. If they don't find both these options, or they are not viable decisions, they can pay all these money as a dividends also. And it could be, by the way, mix of all the 5 things which I am talking about. There might be some capital which might be going to the existing operations. Some might be used for acquisition. Some might be used for paying dividend. Some might be used to pay down their debt. If they have debt on the balance sheet, they can do it. And sometimes they can even buy back the shares. They can buy the shares of the company from the shareholders by paying back the shareholders a certain amount of price. Okay, so these are the 5 ways in which you can distribute the capital. Now there are 3 ways in which any company can raise the capital. One is issuance of stock or equity. So you can give your shares to other party and you can get money in return. That is the first thing. Second is you can issue debt. And that is where you can get it. It could be, corporate debt, or it could be, going to bank and again raising money. Any kind of fundraising through debt instruments is falling into this category. And third is you can use the cash flow of the business to, raise the capital. Okay. So that is the internal organic way of raising the capital, where you don't need to depend on somebody else, or you don't need to actually increase your debt or dilute your equity. So these are like capital allocation decisions which are there. Now, why dividend? Why dividend as an investor? Why it is important? First, it is a sign of regular cash flow. So somebody who is like, retired person who needs a regular cash flow, and they are dependent on that income to run their house, it is very, very important criteria. Because if you don't get the dividend regularly, you might not want to sell the shares on a regular basis. Now, if you ask me, somebody like who is having a other stream of income from business or job, probably it is not a very good decision for them to have that kind of regular cash flow. They might probably want more of a capital appreciation, the share price increase, rather than getting a dividend. And particularly that also depends on the tax bracket. I'll talk about it later on. But if you want regular cash flow, then dividend is a great source of income. And particularly for people who are full-time investors like me, again, it becomes an essential criteria. Again, we have to weigh with the tax angle also, but this is where it's a good sign where you need a regular cash flow. Second is, it is a sign of company strength and free cash flow, that at least they are making money and that money is real, right? A lot of time people fudge the balance sheets, fudge the cash flows, and the cash flow itself is not real. That is where it helps you to determine that, okay, it's having some strength, it is having some excess cash flow, and that is where you can get an idea about the business also. It also gives sign of stability and growth. Like if every year the dividends are increasing with the same payout, like if they have 20% payout, every year that 20% itself is increasing from 10 rupees to 20 rupees to 30 rupees. That means their profits and overall cash flows are also growing. That means the business itself is growing. Okay, so this is where it is very important to understand the payout percentage rather than anything else. So sometimes people fall into the trap when company just are not able to reinvest the capital. But if the payout ratio is same or slightly increasing, and if they're able to give multifold increase in the dividend, then it's a great sign. And fourth, good for senior citizens or low tax bracket shareholders. Particularly before like couple of years, the tax regulation has changed on this. Earlier, dividends were having dividend distribution tax, where companies were paying on behalf of shareholders 15% plus additional cess and all that. But now it is at the actual tax bracket of the shareholder. So if you are falling into 30% tax bracket, you are actually paying 30% tax on dividend plus cess and anything extra which is there. But if you are in a low tax bracket where you are into 5%, 10% kind of bracket, then it's actually a great thing because you are paying much lesser than earlier 15% DDT. Okay, so if you are in low tax bracket, you are looking for some steady cash flows, and you can reinvest that money instead of rebalancing through selling shares, then it's a great thing. Okay, so as I said, it is not always good to have dividend, and getting dividend is not a great sign always, but these are the cases where it is a great sign. Okay, so hope you are getting an idea, and this is where it is very, very important to understand this aspect, because a lot of people have misunderstood the entire thing, and that is where they make wrong decisions and wrong choices. Okay, by the way, if you are liking this video, just type you just subscribe and hit the like button so that I know you are liking this video so far. Now what we will discuss is why it is not important to have dividend, or where dividend is bad. And by the way, if you want to again check out a lot of other videos in terms of what mistakes people make in terms of all these decisions, you can watch this video. It's awesome. 10 biggest mistakes investors make. It's there on my YouTube channel itself. Now let's move to the next point, which is where it is not good. Okay, so the first point where it is not good, let me just hide this for now so that we can go step by step and understand where it is not good. When the overall profits are going out as dividend, and the company is not reinvesting the capital in its future growth, that is where it is a very, very bad sign. I call it as a mango effect. Why mango effect? Because mango is like, you put everything, fertilizer and everything, the growth stops at one point of time, but it just gives you fruits. It doesn't do anything else. It doesn't grow further. So what it means for business, it means that the company is not able to grow. or it could be old business model where the company is not able to reinvent itself. Imagine company like Moser Bear who was earlier selling DVDs. Now imagine the business model has gone for a toss, and if those companies have cash on their balance sheet, they will just give out as a dividend distribution because they are not able to cope up with the technology. Same way companies like Coal India. Okay, so now we know that coal will be extinct after a few years and we'll have more cleaner forms of energy. These kind of companies are old business model companies. Okay, and they are not able to reinvent because of whatever reasons it is. And that is where it is very bad if you are getting into trap thinking that it's a high dividend yield company. Sometimes the management is not able to find lucrative M&A opportunities. They are not able to acquire businesses, and that is where they will give out everything as a dividend, and that is again not a great sign. And sometimes there are mature businesses which are earlier growing, but now they are no more growing, and they are past winners. They did something great earlier, but now they are not able to do something like Castrol, which had a great runway, but now they are not able to do. These kind of businesses also will pay out very high dividend, but you don't need to get into these businesses because frankly it will not grow as much you want as a growth investor. Okay, if you are just happy with some percentage, that's okay. Now when company has very high outstanding debt, okay, the balance sheet is already having so much of debt, and then the company is not giving out paying out the debt, but giving out everything as dividend or majority of the money as dividend. What does that mean? That means that promoter is not willing to pay the debt. That means that probably they are very aggressive in nature, or there is something wrong. Probably, they want to just siphon some money and just play around with the overall capital allocation, and probably they want some money for themselves. Okay, so you need to be careful around this particular point whenever you feel that this is happening, because it's not a great capital allocation sign. It is a poor capital allocation decision. So you should ideally repay the debt first and then think about dividend. If a company is simultaneously raising money, so one hand they are raising debt, and other hand they are paying dividend, that's like a big red flag. Because if you actually have cash flow, why do you need to borrow? And if you need to borrow, why you are giving out that money as a dividend? Okay, so that is a classic case where a company is probably issuing stocks to raise funds or raising debt, and simultaneously they are giving out dividend. Not a great sign. Okay, sometimes the company maintains some small percentage of payout, and just to continue that they might be doing it. That is a different scenario. But if it is a very high amount and a very high debt raising or equity raising they are doing, then there is a problem. If you are somebody on high tax bracket, again as I said, it's not a great sign, because you will lose out like almost 30-35% into your dividend in the forms of taxes. Okay, so if you are on a higher tax bracket, it's prudent to let company intrinsically compound its cash flow, and when you sell the shares, you pay just 10-15% kind of capital gains based on how much you are holding, and that is a much better capital decision for yourself as an investor, right? So let company do the intrinsic compounding, let them reinvest the cash flow at a higher ROCE, and then ultimately when you sell the shares, you just end up paying capital gains tax rather than anything else. Now, a lot of time people have this myth that dividend is a holy grail of income. They have a separate compartment for dividend income and separate compartment for capital gains. Now it doesn't matter actually. So say for example, you have a share which remains at 100 rupees, and you get 5 rupees as a dividend every year. So you are getting 5% return basically from dividend yield. Now same company, if it is paying zero dividend, but every year it is growing in such a way that it is growing its share price by 5%. Now, how does it matter if you just get dividend yield, or you just book out by selling some portion of your shares? It's actually a same concept. So investors ignore capital appreciation as also the means of income and get trapped into high dividend yield for low growth companies. So you should avoid this. Very important. Sixth, wisdom of market. Sometimes the price is falling, but earnings is not yet falling, and you might feel that the dividend yield is actually increasing, where the company is not able to grow much, or they might potentially not grow much in future, and we think like it is just market aberration and we ignore the wisdom of the market. And that is where high dividend yield might potentially suggest low future growth. And this is where a lot of time I see people practicing and knowing just fundamental investing, they make this mistake. But if you also understand the market psychology and try to understand the wisdom of market, you need to actually analyze this company thoroughly to understand whether market is actually factoring low growth in the future. Okay, so if high dividend yield suddenly happens or due to fall in price drastically, there also you have to be careful, because that fall in price might be due to degrowth in the business, might be due to corporate governance issue. And if just you feel like it is a market aberration, most of the times we are wrong when this happens. And 7, potentially management is not keen on buyback, which is a superior capital allocation. So buyback is much superior capital allocation decision in terms of from the angle of company also, and from investor perspective also, where those who want to give back, they can give back. Those who want to participate in future growth, they can stay in. And even tax wise, it is much more optimal. So I would prefer a company doing frequent buybacks rather than giving dividends, particularly in this kind of regime which we are in terms of taxation, in terms of capital allocation. This is a much wiser decision. Okay, so that is where if company is doing a buyback, that is much better. But if it is just forcefully doing dividend distribution, that might be a lower capital allocation decision. Okay, so that is pretty much on the dividend part. I want just to give gift to all of you. If you are here till the end, this is one of the learning system session which I'm going to do. And just because you are here live, I'll give you complimentary access to this session. So what you can do is just go to this link, technofunda.co/live. And you can register for free just because you are here. And I'll also share the link in the description. And that's it from my end. Hope you enjoyed this entire session and hope it was value additive. We'll meet you in the next future sessions where we'll learn a lot of such amazing, important things which will help you in your decision journey. Thank you for now. Take care, and we'll see you in the next video on this channel. And don't forget to subscribe and like this video before we end this video. Thank you so much.